Next, I have the pleasure of introducing the always delightful and insightful Jeff Ford and Megan Troxell, both partners in the A&A Group, for an A&A update. The A&A Group provides audit services, review and compilation services, transaction-related services such as quality of earnings reports or navigating accounting services in navigating the frequent complexities of buying or selling a business. We also have the privilege of guiding our clients through accounting standard updates such as Topic 606 a few years back and still relevant here, and Topic 842 on leases, particularly over the last year, and which we'll discuss again today. Please join me in welcoming Jeff and Megan.
Thanks. Thanks, Austin. Welcome, everybody. Megan and I want to say thank you. I think you've heard it many times today, but we so much appreciate everybody being here. I think most of you have heard this already today, but there will be no paper certificates. They will all be conveyed to you electronically, which is also good. You may have noticed, if anyone was looking, that we're ending at 4 o'clock this year instead of 5 o'clock. We hope there aren't too many objections to that, but we're taking a page from our European friends and just shortening our work hours, so we look forward to that. We talk each year about A&A update, and okay. Well, so there won't be a slide update on the my right-hand side of the screen. But at any rate, we'll talk about some objectives that we want to have as soon as I can get the green thing to move. Look at that. Here we go. So thank you for that. We talk about really similar objectives each year. We want to talk about things that are newly applicable. We want to talk about things that primarily affect private companies, and we want to have a higher level executive approach to this approach. We avoid certain topics, and we avoid them intentionally. We avoid international standards. We avoid things that apply to publicly traded companies. We avoid things that are industry specific, think banking, healthcare, things along those lines. And we avoid excessive discussion on derivatives and hedging. We will be talking a little bit about that as we dive into it this afternoon. So when we talk about new and newly applicable standards, Megan's going to kick it off with a handful that begin with income taxes.
All right, so we will start with ASU 2019-12 related to Topic 740, income taxes. This ASU is part of FASB's simplification initiative. So we see 4 changes to current guidance as well as some new guidance, all with the aim of simplifying. First, prior to the ASU, an entity would generally allocate total income tax expense or benefit first to continuing operations and then to any other items, for example, discontinued operations. However, there was an exception that required an entity with a loss to consider all components, which meant that a loss-making entity could in fact report a tax benefit from continuing operations and then an offsetting tax expense from the other components. That exception has been removed, meaning that there will not be any offsetting tax differences between continuing operations and other operations. Second and third, there are exceptions removed when an entity transitions from the consolidation method to the equity method of accounting for a foreign investment or vice versa, transitioning from the equity to consolidation method. And then finally, there were some exceptions removed relative to interim period tax accounting. Next, we move into some true changes that were not simply just removing exceptions. First, franchise taxes that are partially based on income are now required to be accounted for as income taxes, and then any additional non-income based portion of those franchise taxes would be accounted for in the pre-tax income. And then next, there is a required evaluation to determine whether a step up in tax basis of goodwill should be considered part of a business combination or as a separate transaction. So the ASU has prescribed factors that would indicate when that step up in tax basis should be considered as a separate transaction. Thirdly, The ASU clarifies that an entity is not required to allocate any portion of the consolidated taxes to an entity that's not subject to tax. However, an entity may elect to do that. This ASU is effective for periods beginning after December 15th, 2021, so really, very applicable at this point already for private companies. Next, we will go to ASU 2020-06. It's another update geared towards reducing complexity and streamlining reporting. This update is focused on changes to topics 470 and 815 related to debt and derivatives and hedging. The key takeaway here is that the ASU reduces the number of accounting models for convertible debt and preferred stock, and it also amends the disclosure requirements to increase transparency. The update also provides a scope exception that simplifies accounting for contracts in an entity's own equity, making it easier to account for those. This ASU is effective for private companies for periods beginning after December 15th, 2023. And I'll turn it back over to Jeff now.
We'll talk a little bit about reference rate reform. Some of you have heard about the fade out of LIBOR, which is all but completed now. But this ASU's 2020-04 and also 2021-01 really relate more to hedge accounting. And if you think about it, reference rate reform has a much more complex impact on hedge accounting than it does on a given term loan, for example. So they have guidance there that allows options with regard to retrospective approaches or prospective approaches to reference rate reform for hedge accounting. If you have that involved, it's important to look at the abundance of information in the statements about that. For most of us, however, who have term loans or lines of credit, it's been a relatively smooth transition from LIBOR to SOFR over the last couple of years, so relatively seamless in that regard. Next, we're going to talk a little bit about stock compensation. Sometimes I can't help but editorialize a little bit up here, and this is another of those cases. We think this is a very positive pronouncement. It's very, very helpful to private companies. It applies only to private companies, but it was really driven by the fact that the standard setters realized, accurately so, that determining the fair value of these share-based awards was both difficult and expensive. Very, very true. Anyone who's gone through that recognizes difficult and expensive. So there's a number of things to remember that need to be done. They need to be valued at the grant date, not exercise date. An important thing to remember. Also remember that there's many factors that come into play in these awards, and they don't always get handed out to employees. Share-based awards can go to service providers, typically attorneys, maybe other vendors, and so on. Our profession isn't permitted to take such things, but others are. So this applies evenly to both employees and other recipients of share-based awards. And what it says is that you can now have any reasonable or a reasonable valuation method to determine that value. And then they go on to talk about what is a reasonable valuation method. And think about the things that may be involved. And think about the fact that they really include most of those. Most of us that have done that have seen a Black-Scholes model. You can't really attend a Melissa or Brad presentation of valuation without hearing something about discounted cash flow. A decent discounted cash flow model is a reasonable valuation method. Of course, the external independent valuations performed by Melissa, Brad, and their team count. They qualify. It's very important that this conforms to and is in alignment with the infamous Section 409A, the bane of all technology-based company stock awarders. And it does a great job of outlining the things the evaluator has to look at. It has very clear criteria as to the factors that have to be considered, the scope, the dates, the timing, etc. So I find it to be a very helpful pronouncement to the private companies that are doing share-based awards. Next, we'll talk about government assistance. Government assistance was something that we really didn't talk about prior to 2020. And I'm hoping that as we go forward a few years, there will not be the need for the motivation for additional government assistance programs. The biggies, of course, were PPP and the ERC. There were others. We won't talk as much about the others. And the FASB was conspicuously silent on those issues, intentionally and conspicuously. So what they finally came out with was guidance that basically didn't tell you what to do. It told you that it would be a good idea to tell the readers of your financial statements what you did, where it was in the balance sheet and the income statement, disclose what it was, what you did, maybe even why you did it. But also make sure that you stay within the lanes of the other guidance. And I choose the word lanes intentionally because with no explicit guidance, some of you may remember that we look to analogies. We look to analogies for debt or analogies for conditional grants. All that's still open, but really, to the extent there's PPP, ERC, or other government assistance, by and large, unless governed by other pronouncements, it's just tell them what you did within reason, and there should be a logical basis for whatever you did. Next, business combinations. Another one that I think is a good one. More of those this year than some. Before we talk much about business combinations in this ASU 2021-08, really remember, and I'm sure all of you do, 2017-01, which defined a business combination. Business combinations were seen to be overused by our profession. We were saying everything was overused. If I bought this table, they said I bought a hotel business. So the standard setters very artfully delineated what was a business versus what was some other asset. A license, maybe a franchise right, something along those lines. So if you qualify to be a business combination, then some new relief also perhaps comes your way. And that is what to do with this whole complex thing of revenue with contracts with customers, because 606 invaded everything, including business combinations. You still need to stay within the boundaries of 606 with regard to revenue recognition, but what about these acquired contracts with customers? In the standard, or this ASU said pretty much, I'm paraphrasing, pretty much said that the buyer should stay consistent with the parameters of the seller. So treat the contracts the same way the seller would have for revenue recognition in a business combination, so long as the seller was on GAAP. If the seller was not on GAAP, the buyer then has to go back and reevaluate all those contracts. But to the extent that the seller wasn't on GAAP, the buyer has to go back and reevaluate all those contracts. To the extent they were on GAAP, you essentially have a glide path into the transaction and the reporting for those contracts with customers. I said we wouldn't talk a lot about derivatives and hedging, partly because I have trouble getting that out, the tongue twister that it is. But our next slide, which is ASU's 2022-01 on derivatives and hedging, talks about multi-layered hedging strategies in closed portfolios. This came out in 2017. I made the mistake of reading it somewhere around 2018, and I really haven't read it since. I think it has limited applicability, but I will tell you this much. If you do have multi-layered hedge strategies in a closed portfolio, there is an amazing amount of information in this statement for you. And it actually expands one's options. Its purpose was to give more flexibility to the reporters, particularly with regard to the last layer approach. So I don't particularly do those, but it's important to know that it's there. Next, and relatively famous, but now just applicable this calendar year for private companies, is the CECL pronouncement. 2016-13, it should say, I think it says 2016-16, it should say 2016-13, and 2022-02, credit losses. This does a number of things. Again, public companies have implemented this a long time ago now. This calendar year is the first year for private companies. And it really changes one's perspective. The old way is one looked at recognizing a problem when the problem became probable. And the perception of probable can vary in the eyes of given beholders. So when the problem became probable, one was to recognize it. Now they're saying, no, that little probable was based on backwards looking, like Melissa said earlier, history is often a proxy for the future, but we want you to have a more comprehensive perspective. And I think they even use the term comprehensive in their referencing analyses in the CECL statement. And they said, let's look at a number of things. You can look backward, but let's also look at forward expectations, forward-looking expectations. And let's do something else. You need to estimate not only your credit losses, but let's go ahead and recognize the lifetime credit losses now, as opposed to, again, maybe deferring, hoping for the best, or sliding the trigger point of the term probable. So that's probably not going to be a big change for most private companies that aren't lending money. There's some guidance for lenders. It really changes the troubled debt restructuring stuff. And there's some other guidance if you are, in fact, a lender. It'll primarily be a little change in terminology for most private companies that merely have trade accounts receivables and similar items. Now I'm going to turn it back to Megan for a handful of slides.
Okay, for ASU 2022-03, this ASU provides clarifying guidance on the measurement of fair value for an equity security that has restriction on the sale of that security. This update was issued because there was diversity in practice for how the sale restriction was impacting the fair value measurement of equity securities, and ultimately indicates that a contractual sales restriction should not be considered in measuring the fair value. However, there are some additional disclosures that come along with these types of securities, mainly relating to the remaining duration of that restriction and any circumstances that would cause a lapse in the restriction. This is effective for private companies for years beginning after December 15th, 2024, and early adoption is permitted here. This ASU is not really expected to have a significant impact on most companies with these types of securities, but rather to provide consistency and comparability in reporting. Next, we have ASU 2022-04. First, let's take a look at what we mean here by supplier finance programs. So this is any program that allows a buyer to offer its suppliers the option for payment in advance of an invoice due date, which is paid by a third-party finance provider or some other intermediary. These arrangements may also be referred to as reverse factoring, payables finance, or a structured payables arrangement, and are really geared to be a creative method for financing. Typically in these arrangements, a buyer in a program would enter into an agreement with a finance provider. They would then purchase goods and services from its suppliers with a promise to pay in the future, and then they would notify that finance provider that it has confirmed the purchases as valid, and the supplier could then request early payment from the finance provider for the confirmed invoices. So prior to this ASU, there was really no specific guidance related to these types of programs, and so there was a lack of transparency that they were going on. Often these programs would simply be lumped into the same line item as accounts payable on the balance sheet. So the new disclosure requirements will include providing information about the key terms of these types of programs if they exist, including the payment terms and any assets pledged as security or other forms of guarantees. This is effective for years beginning after December 15th, 2023 for private companies, and early adoption is also permitted here. So after much anticipation, the implementation of the new lease standards are finally in the rearview mirror for most of you, and we can now move into discussion on best practices for practical application in day-to-day accounting and presentation in the disclosures to the financial statements. As a reminder, it was a long journey to get to where we are today with the current guidance for leases. The core accounting standards update, or ASU, was issued in 2016-02, and then subsequent ASUs modified the original ASU, including some deferral of the effective dates. Ultimately, we've landed with a new topic section in the FASB codification, topic 842, leases. So overall, what is the impact of the new lease standard? Hopefully this isn't news to you, but simply put, we're putting lease activity onto the balance sheet so that we're more accurately reflecting the financial position of an entity and eliminating that off-balance sheet financing. This does impact all entities with leases, including subleases and related party leases. It's important to note a few exclusions to the new topic 842, which would be intangible assets, inventory assets, assets that are under construction, and exploration of resources such as oil and natural gas. The transition from the old method of accounting for leases to the new model is a modified retrospective approach, which we'll see more specifically as we continue through some examples. The major impact of the new lease guidance is on lessees, where we see a right of use asset and a lease liability for leases with terms over 12 months being established and reflected on the balance sheet. The liability is measured based on the present value of the future lease payments using a reasonable rate. And then the asset is based on that determination of the liability, subject to adjustment for some other items. Topic 842 does retain the dual model, requiring leases to still be classified as either operating or finance, previously what was referred to as capital leases. And we'll take a look at the differences there. The next few slides summarize the impact of leases on the financial statements themselves. And as we've worked with our clients over the past year or so on implementation, we've seen that this is also what really drives the disclosures as well. The disclosures for leases are basically restating where the impacts of lease accounting are showing up in the financial statements. So for finance leases, we'll see that on the balance sheet, you have a right of use asset and then a debt-like lease liability. On the income statement, you have your amortization expense on a straight line basis, as well as interest expense. And then on the cash flow statement, you'll have your principal payments that will be in the financing section of the cash flows, and interest and all other lease-related payments are in the operating section. For the operating leases, similarly, you have a right of use asset, and then you'll have that offsetting lease liability. On the income statement, you have a single lease expense on a straight line basis, and really this looks the same as what it previously would have been under the old guidance. And then all of those lease payments are essentially reflected in the operating section of the cash flow statement. While most leases are now reflected on the balance sheet, there is still that determination of whether they are operating or financing. And the determination of whether a lease is a financing lease is similar to what it was under the old guidance, but the language for each of the criteria has been made a bit more vague, leaving some room for interpretation. On the right-hand side of the slide, you'll see here what the new criteria are. If ownership transfers to the lessee at the end of the lease term, you will have a finance lease. If there's an option to purchase the asset and the lessee is reasonably certain to exercise that option, it would be a finance lease. If the lease term is the major part of the remaining economic life of the asset, you would have a finance lease. If the present value of the lease payments exceeds the fair value of the asset, you would have a finance lease. And there's a new criteria that is added that if the underlying asset is specialized in nature, such that there would be no alternative use, you would also have a finance lease. So if you meet any one of these criteria, you have a finance lease. If you do not, then you have an operating lease. We have some examples here in the slides, and I'll go through the first one here, and then we'll have a second one that we'll sort of go through a little bit more quickly. But to give an example here, we have XYZ company that enters into an operating lease of a building with ABC on January 1st of 2022. We have the information here relative to the fair value and the term of the lease, and what the annual payments are over the course of the term, and then what the interest rate is implicit on that contract. So based on the fact pattern that we have here, this would be determined to be an operating lease, and we would need to recognize that as of the date that that lease was entered into, and then it would be amortized over the life of the lease. So we see on the next slide here, the amortization table calculates the present value of the lease, and then we see that amortized out over the term of that lease. And then on the next slide, we have the actual accounting entries that accompany first recognizing the right of use asset and the liability, and then over the course of the term, recognizing that annual lease payment and the related expense, as well as the amortization of the right of use asset. So example 2 is pretty much the same fact pattern as we just went through in example 1, but it adds the complexity of initial direct costs. That's incorporated in the narrative, and then we have that in the amortization table. There's an additional column added there for the indirect costs, and then that's incorporated into the accounting entries that we have here. So at this point, most of you have already made the transition to the new guidance, so we'll cover this briefly. There are two modified retrospective applications, either the comparative option or the effective date option. Under the comparative option, the standard would be applied at the beginning of the earliest period presented with a cumulative effect adjustment to the opening balance of the equity in that period, if there was any. Often there's not. And then your disclosures would follow in line with that. The other option would be the effective date option. This is what we've seen most of our clients implement, and in this case, the standard would be applied at the effective date, which in many cases would be January 1st, 2022, with a cumulative effect adjustment, if there is any, to the opening balance of equity in that period of adoption. The disclosures have a little bit more to them, recognizing that the 2 years are not comparative, but that's a relatively easy hurdle to get over. As far as transitional relief, we did get the benefit of some transitional relief with practical expedients, which were helpful. First, an entity did not need to reassess any existing contracts to determine if they had a lease component to them. So it is important to note that going forward, all contracts, whether or not they actually are called leases, need to be considered whether there is some kind of lease component in that contract. Second, an entity did not need to reassess the lease classification. So if it was considered operating before, you could continue to treat it as operating. If it was considered to be capital, you could continue that treatment. And then last, existing leases did not need to be reviewed for any initial direct costs. If using these practical expedients, you did need to be consistent and apply all three of them at the same time. And we're going to skip that one. As far as the impact on lessors, the impact of the new lease guidance on lessors is rather minimal, as topic 842 and the old 840 use very similar models, and there's still classification by the lessor as either a sales type or direct financing lease. One practical consideration for all of you to think about is whether any of your short-term leases can be excluded from balance sheet treatment. A policy may be elected for leases with terms 12 months or less, as long as there is not a purchase option associated with that lease. This would still keep the treatment consistent with previous GAAP. Few other items just to take note of here. First, the term of a lease is defined as the initial term plus any likely renewals that are in the contract. So for example, if you have a 3-year office lease with an option to extend for 3 years and you are likely to renew that, you would want to account for that lease initially using that full 6-year term. And then once established, the term would really only be reassessed if certain conditions would arise, which would indicate that you needed to take a look at that. And additionally, a few other matters to consider here. If you have a bundled lease, you need to segregate and consider each component. The sales leaseback guidance in topic 842 does more closely align to revenue recognition. And then finally, there's some clarified guidance for related party leases. So finally, for anyone who has a lease disclosure in your financial statements, you know that that means the page count to your statements probably increased by at least 1, if not more, pages. So I can't believe that this slide really only has 2 bullet points relative to disclosures. But as I mentioned previously, the disclosures for leases really are just providing a roadmap to where the different components of lease accounting are reflected in the financial statements. So you're giving the readers to the financial statements a roadmap back to where all of that is reflected in the statements. Beyond providing that roadmap, I would say there's also some requirements for disclosing the details on how the amounts for leases were determined, such as the weighted average terms and the rates used there. Last, now that topic 842 is applicable for most of you and you have implemented that, it's important to perform ongoing monitoring of your lease activity and any new leases that are entered into, and to have some good record keeping for the details of all those lease arrangements. I will turn it back over to Jeff.
We're going to talk a little bit about auditing standards. You may say, why does that apply to most people that aren't in auditing? Well, certainly they apply to those in auditing, but we're going to focus on a couple of the standards, the SASs between 134 and 146, that apply a little bit more to those being audited and even to some extent those using audited financial statements. So there was really a little package that came out, 134 to 140, and they were all to be applicable by December 15th, 2020, and we'll talk in a few minutes about SAS 141 that merely delayed that implementation date. You've seen most of the impact of these already. 134 really changed the audit report. It changed the independent auditor's report in a relatively meaningful way. If nothing else, it got a lot longer. Some of you may have noticed that already. The content of what constitutes an audit didn't change, but the degree to which that was articulated to the reader was greatly expanded, and some view it to have been enhanced. When you move forward to SAS 135, you have another thing going on. There's several things that oftentimes, whether it's audit standards or FASB statements, there's a desire to conform different constituencies, PCAOB to SEC to IFRS and so on. So you do see some alignment standards, and they did want some alignment standards with regard to 136 as well. More interesting, with regard to 135. With regard to 136, much more interesting, it was a different approach to benefit plan audits. It changed the auditor's report, much like 134 did, and this time it became much longer, usually 4 to 5 pages, depending on the information therein. And what we all became used to is a limited scope audit, which is nice and concise, but the standard setters thought was misunderstood because there would be a disclaimer of opinion, was changed to a 103A3C audit, which allows the auditors to actually opine on particular elements of that, especially those that are being audited at that time. So probably seemed to be very helpful. I think it's maybe a little long of an audit report, but the essence of it is very positive in many regards. There's another statement that follows, 137, and that really kind of updates things that I think I remember for a long, long time. That when you audit somebody and they have an annual report and any other documents that they promulgate in any way, the auditors are required, if the audited statements are included in that, and the annual report kind of being a great example of that, the auditors are required to peruse, to read, and to look for inconsistencies or outright contradictions. You don't want your annual report saying we had an extremely profitable year and the audited financial statements therein to say there's a going concern problem and large losses. So a lot of it goes without saying that it ought to be done, but this was a great opportunity to further codify the responsibility both on the issuer and on the auditor to make sure things are not inconsistent with regard to information such as annual reports that contain audited financial statements. So we have a fun one now, 138. I think it's fun because it updates materiality. It does a number of things. It really focuses on materiality and the concept of an audit. That's important. And it conforms the concept of materiality and some of the definitions among not only audit standards, but also the U.S. judicial system, PCAOB, SEC, FASB, IFRS, and so on. So that's a pretty good thing. They fold it all into AUC Section 320. It's becoming applicable, or it is applicable already. And it does a number of things with that concept of materiality. Once again, it's to be looked at in the context of an audit. It says that materiality is to really define the likelihood of material misstatement occurring. And it emphasizes the fact that a risk of material misstatement There's a material item if it's likely to influence the judgments of a reasonable user of those financial statements. So a number of things are embedded in that. Will it influence the judgment? Will it change the outcome or somehow tilt their judgments a different way? And it would be a reasonable user, not necessarily someone on the fringes or some extreme example. And it's really to be looked at individually in the aggregate. Each item, each potential error is to be looked at individually and in the aggregate, your group of errors. I think those of us who have been auditing a long time remember different firms have different charts, but everyone has a chart that shows the summary of unadjusted items or SEE or SUD or whatever, depending on your firm. And it's really encouraging you to look at both qualitative and quantitative issues. We're in a profession that loves to quantify the qualitative, but this pronouncement goes a little bit farther, and it really emphasizes the fact that there is no bright line. We always, maybe some of us were taught a long time ago, the 5% rule. Well, the 5% rule is about as valid as the 5-second rule if you drop your cookie on the floor. It doesn't hold water. The cookie's still dirty. If it's 4.5%, it might still be material if it has a high likelihood or a reasonable likelihood of influencing a user's judgment. So no bright lines. I know we all wanted bright lines. And you need to look at a number of factors with regard to that situation. Interestingly enough, and I know black and white auditors hate this too, interestingly enough, materiality may differ area by area or account by account. Or it may differ based on an industry that the entity's operating in or an economic environment, et cetera. So this additional materiality guidance really helps bring order to those situations. So very, very helpful in many regards. Moving from there to SAS 139, it's really amending a bunch of things, another alignment one, so I won't spend much time on it. 140 was really conforming all these other areas, which you can see listed on the slide, to 134 and the statements that change the auditor's report, for the auditor's report and the pension plan auditor's report. And it pushed that information back into all these other areas that would be affected by those, ripple effect into that. And it did something else. It basically said there was a lack of consistency in practice about supplementary information. And it said, when there's supplementary information with your financial statements, it needs to have a separate report. It needs to be called out. And many firms already did this. Supplementary information and an opinion on that, or whether there was or not. Rather than just what was done a lot of times in practice, was just an other matter paragraph. They determined that was too vague and said, let's be a little more explicit, aside with pushing through the other concepts really throughout. 141 was really straightforward. Everybody was claiming, appropriately so, a couple of years ago that it wasn't the time to implement these other SASs, so it just delayed it a little bit of time. So now we move to some newer ones. Everything I'm talking about now will start to be applicable for years beginning after December 15th, 2022, so that means for calendar 2023. And some a little bit later will be even after that. Audited evidence is a kind of a good one. 142, it talks about the auditor's responsibility with regard to gathering evidence and so on. But I think the interesting thing there is it talks a lot about auditors' use of technology or electronic tools in gathering that audit information. And I've seen a couple of different continuing ed presentations on this topic alone, and really there's a lot of disparity in the views of some of those presenters. Some think there needs to be an overwhelming abundance of documentation of that evidence and why it's appropriate evidence, and others are saying, hey, a couple of bullet points is all you need to go. And I think that as the standard setters, as the AICPA, and even some of the people that wrote it continue to speak, they're saying, no, it's a lot closer to the second one. Maybe one little bullet point isn't enough, depending, unless it's a well-written bullet point. But also, very importantly, it talks about the use of these electronic tools. And it says that's okay. You can use Data Snipper, or you can use something else along those lines, or some other electronic audit tool to draw the information out. And the fact that it wasn't a human being pulling out the information does not invalidate the audit evidence. But of course, there's guidance to that. And of course, we're still required to have the basic tenets of auditing in place: adequate supervision and review, relevancy, etc. So we're able to use technical tools. Moving forward to 143, we're talking about accounting estimates. In it basically updates the definition of the concept of an estimate talks about the fact that estimates by their nature involve some degree of uncertainty. It really gives some guidance about that. And this is one of the ones that is effective for years beginning after 12/15/2023, so next year for that. We have another 144, which is use of specialists. Use of specialists is an important thing. The gist of that, again, in my mind, is not conceptually different from the old guidance. It's a more enhanced, more clear version. It's a little bit of a shame on you for not doing it, but it's a real clear guidance that says if you're going to use a specialist, think an actuary in terms of a pension plan, a defined benefit pension plan. Think of an environmental engineer if you're trying to estimate the amount of an environmental liability, because they could be quite large. And they talk about the criteria that one should use and the author's responsibility for the inputs and the outputs, et cetera, when one is relying upon the work of those specialists. There was a firm, a large firm, one of the famous Big Four firms, that got in a lot of trouble a couple years ago. They got smacked pretty hard by the PCAOB because they were basically imposing fees on their clients to redo the work of some of the specialists. And the standard setter said, no, 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 incorrect. You either can rely on them or you can't. And you need to document why or why not. And I'm paraphrasing and oversimplifying a little bit too, but it really does if you're using specialists, and most of us do for certain contexts like I just mentioned, you need to follow this information. Many of you have been doing that already, but for everybody else, calendar 2024, it'll become a little bit more real. With regard to the next one, risk assessment. This is probably the big one. I'm going to check the time because I know you don't want to be here till 6 o'clock. But the risk assessment one is really based on the audit risk model. Some of you remember the audit risk model. The risk of material misstatement is really the product of inherent risk times control risk, times detection risk. That's a risk of material misstatement, right? And they have a lot of enhanced guidelines as to how one goes about that and how one documents the understanding of the control environment and the control operations. And they point out a number of things. They point out that you have to look at the entire control environment. It was kind of fun a couple decades ago when you could go into a private company and say, hey, they got no controls. My understanding of it doesn't have to go any deeper than to shrug my shoulders and say they're not very good at it. And I test everything at a maximum level of control risk and do substantive tests of details. We still may land there, but you can't land there that directly or that one bullet point approach sort of thing. So I said there's a number of things you really have to look at in that environment, and you need to remember certain things. One of the things they emphasize dramatically is that all entities have controls. All entities have controls. This was a big sticking point. In fact, I was part of some of the PI CPA tours when this was coming out. And the passion with which some of the smaller practitioners responded to this was amazing, very passionate. It is not true. All entities have controls. Many of those controls may not be auditable. And one of the technical heads confronted a group in one of these presentations who was saying that the argument there are no controls. And then the response was, well, I hope you didn't audit them because you just described an inauditable situation. So remember, if you remember nothing else about this, all entities have controls. They may not be auditable. And really one of the neatest ones, one of the most important ones, is tone at the top. Tone at the top is pivotally important for the control, environment, operation, and everything else, especially for small and medium-sized entities. I remember a study that our prior firm did that ran from the 60s to the 80s. And I saw it in different fraud contexts carried forward. The means of detecting fraud, for example, were sometimes by internal audits, sometimes by external audits, sometimes by some other means. All of those tended to be in the 5 to 15% zone of detection. Now this one may fluctuate a little, but it's almost always between 60 and 80-something% that is a function of a whistleblower. And the ultimate motivation and why, aside from all the justification we heard earlier in that fabulous presentation by Ray, oftentimes the attitude was hatched by the attitude of those at the top in a couple of ways. If those at the top were casual about following the rules, the people felt it easier to do those justifications that you heard about earlier. And that's not just fraud. It's also with carelessness with accuracy of financial reporting. If those at the top are, close enough, no worries, it's within the boundaries, close enough for government accounting as the probably inappropriate expression goes, then there's a much higher chance that you're going to have material misstatement throughout, because the attitudes will largely, as you heard today, not entirely, but they will largely follow. So tone at the top is critical. So you sometimes look at that, it's in the checklist, and you say, what are you going to say? It's awkward to write something negative there, but the auditors have a responsibility to assess that objectively, tactfully, objectively, and respectfully. So what about internal controls over financial reporting, or the IFCR? Well, the preceding bullet point says that processes and procedures are not controls, but they're a big component of controls. So the internal controls over financial reporting involve the processes and procedures that are in fact designed and implemented by management with a purpose in mind. And that purpose is to prevent, ideally prevent, or to detect and correct material misstatements. So those things represent, and again, we can go into the multi-page version of this, those things represent your internal controls over financial reporting. There's some other key points related to audits. Key points related to audits are, remember the materiality thing? If it's small, it's not a big deal. If it's small, it's not a big deal. I remember a new hire several years ago. I certainly don't remember which one it was, so I won't have to worry about naming them. They were upset because the company was looking at allocating their electric bill for accrued expenses. And they were kind of doing like this kind of half-month thing. And they're like, well, it's only like 7.5 days. Like, it's okay. So if it's not material, it doesn't matter from an audit risk model. But remember materiality. If it is material, it might matter a lot. So you have to consider materiality. You have to consider the significance of the risk. Significant, insignificant. 2 days different on an electric bill, probably not significant. The size and the complexity of the entity. Certain things are more material to some entities than others. Obsolescence of technology doesn't really matter that much to an old line yellow cab company. It matters a whole lot to a cutting-edge technology company. So again, you think about where it is, what's important, where the risks are, and you look at the nature of the business, which I guess was also encompassed by my last on-the-fly example. The other key point, shifting away from the auditors, are certain things are always relevant, whether we think they should be or not. Certain things are always relevant with regard to risk management. Journal entries. Journal entries are where a lot of bad things happen. Journal entries where people, more often than fraud, usually they're just flailing around and either making more errors or covering errors. I might have done the same in proposing those at a point or two in my career. But journal entries are key. Some things are always significant risk by statement on standards. The standard setters tell us that revenue recognition is always a significant risk. Even when it's not, it's a significant risk. Even if your foundation does nothing but have investment income on a bunch of investments, revenue recognition is still a significant risk, and you just have to show why you don't really have to respond to it because they don't have any. But fraud risks are important, and we talked a little bit about fraud risks. Remember, fraud risks are really key, and the way to stop them is to design procedures that never tempt the honest person. Something that's a little newer, but should have been relevant for a long time, is the IT general controls, and they have an acronym for that too. You have to be cognizant of the IT controls. We used to call it, dependency, IT dependency or not, and that's kind of evolving because almost every entity has a degree of IT dependence in this era. And the thing that you need to do to pull this all together is to think of both design, implementation, and operational effectiveness. The best of a design control environment, if it's not implemented, then it ain't good. I have a great fitness plan. It's just not implemented as well as it might be. So the outcomes aren't maybe what they look like on paper, right? But if you were auditing my fitness plan, I could show you the design. You'd probably be impressed. But if you start looking at the implementation, you'd be a little sketchy. And you're also supposed to test the operational effectiveness. Might be a management letter comment coming to me there. So I think you need to look at all three. You got to test, is it working? Is it relevant? Is it working? Is it designed well? Is it implemented? So that's the end, other than this forthcoming one, which I think will give me great pain and suffering when it's effective after 12/15/2025. And it sounds like it should be good. It's kind of like the Affordable Care Act or the Inflation Reduction Act, some of us were joking earlier. And it's a quality management for basically audit engagements. And it imposes a lot of changes to monitoring and management, and some of them might be good. I just hope they kind of narrow it down a little and focus us a little better, changes the roles of audit engagement partners or expands those or expands their responsibility. And it does a number of other things designed to make more consistent and to raise the level of quality affected by firms performing audits. I'm going to skip over the potential changes because the FASB is always talking about certain things, fair value, derivatives, and so on. And I want to jump forward to Department of Labor change, which should be a couple slides from now. Department of Labor has a new thing where they're changing the rules with regard to benefit plan audits. For a long time now, you triggered a benefit plan audit if you had more than 100 eligible participants, not actively participating, but eligible. Well, there's an 80-120 rule, so if you go from 80 to 105, you can still wait a little while. That continues on. But they've changed the perspective. They've changed the perspective and said instead of eligible participants, beginning for January 1st, 2023, so this calendar year pension plans, it's based on participants with account balances. So there are companies, particularly retailers, that have a whole bunch of potentially eligible and very low participant count. Well, they would have been subject to audit before, and they're not anymore. So it's kind of interesting because when they made this change, they said they wanted to reduce these plan audits by 10,000 across the nation. That sounded like a big number to me. So I said, well, Pennsylvania is 3.94% of the nation's population. So it would be 400 less in Pennsylvania. Okay, I think that makes it more palatable to me. But the flip side of it is some organizations that basically have their alumni leave money in their plan, which could be a lot of professional service firms, not naming any in particular, have sometimes maybe more people with account balances than they have employees. So it's going to trigger some more audits for that, but it should overall be a net reduction. And remember, the 80-120 rule still is in play. So I think, if I check my handy timer here, I am within 1 minute of the completion time. And a couple of very important things to point out. I know A&A update is so riveting that some have requested an encore presentation at 6. I'm not sure we've been able to arrange that. But most importantly, I think as you've heard through the day, through the excellent MC work of John, Morgan, Austin, et cetera, we truly and genuinely appreciate your friendship, your presence, the opportunity to work with you. It's really one of the things that makes the profession fun. The profession is more about the people than it is about the technical pronouncements. And stealing again, and some of you may have heard me say this before, the chairman of the firm that taught some of us had a saying where he defined success. Success is looking forward to going to work in the morning, looking forward to going home at night. And really, I think we all look at you as allowing us to have part of that first part. Make us look forward to coming to work in the morning. We thank you. Nice to see you, and we look forward to seeing you next year. Safe travels home.